Hello, I'm Stephen Kress, head of quantitative strategy at Seeking Alpha, and I'm joined by Emma Johnson, our quantitative strategist. And welcome to Finding Opportunity in Uncertain Markets with Alpha Picks. First, a little housekeeping. I apologize for the disclaimer, and I'll try to get through this quickly. We're not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment security strategy or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by subsequent events. It represents my opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. I think that could be a record for me, Emma. Just by way of background, as I mentioned, my name is Stephen Kress. I'm head of quantitative strategy at Seeking Alpha. I have quite a long tenure on Wall Street, going almost 35 years, and working in the city of London as well. Predominantly, most of my career was spent at Morgan Stanley, where I worked for 13 years, heading up a quant trading desk. And I also had a hedge fund that was based on quantitative strategies, as well as founding a fintech company, which was acquired by Seeking Alpha 6 years ago. And part of the deal was to join Seeking Alpha and integrate my technology into their platform. And I haven't left because I really enjoy it. Emma, could you share a little bit about your background?
Absolutely. Thanks, Steve. Just a reminder to folks, the chat is open. We'd love to get some of your questions as the presentation rolls through so we can try to address them at the end. So please chime in and I'll monitor some of those. But as Steve mentioned, I'm a quantitative strategist here at Seeking Alpha. I've been with the firm a little over a year. And my previous experience is with an asset manager working in systematic quantitative strategies, so very closely aligned to what we're doing here on the quant team. You can find me regularly contributing to premium webinars and articles, as well as the Alpha Picks portfolio selection process, webinars, write-ups, and more recently, our latest product, Pro Quant Portfolio. So I'm a bit all over the place, but great to be here today.
But a great quant strategist, I will say that. So a little bit about what we're going to cover today. What is quant? We're going to touch on the markets and the economy, as well as an introduction to Alpha Picks and portfolio highlights for Alpha Picks. So leading off with our quant vision, which is to eliminate emotional investing and uncover top stocks using data-driven tactics. To get a little deeper into that, basically, we want you to be able to make choices without emotion, based on the numbers of a company and the numbers of that company versus its competitors in its appropriate sector. But what we'd really like to do is help you eliminate emotional investing. So what is quant? Quant is a methodology that uses data, math, and algorithms to find investment opportunities. But more simplistic, really, quant performs the same functions that an analyst would at Morgan Stanley or Goldman Sachs. We're looking for companies that have strong investment fundamentals. So we share that expertise with analysts. Specifically, what we look for are companies that are collectively strong on value, growth, profitability, upward EPS revisions, and momentum. And many analysts, when they look for stocks, they're looking for at least three of those core investment characteristics, which would be value, growth, and profitability. And the only problem is an individual analyst, you can only cover maybe 10 to 15 stocks in your entire universe. And it is really beyond human capacity to cover more than about 15 stocks well, which involves writing up those stocks, analyzing them compared to the sector, and determining how their metrics stand versus the sector. When we use quantitative analysis, we're using the power, very, very powerful computer processing. And we basically can take that investment analysis, plug it into a computer, and it gives us the ability to look at 5,000 stocks as opposed to 10 or 15. And we get to analyze those stocks and produce directional recommendations every single day, where an analyst only has the capability to keep an eye on those stocks and really do a deep dive maybe once every quarter on each individual stock. So we're taking what an analyst does, basically taking what I used to do as an analyst and plugging it into a computer and making it a systematic process. And this gives us the ability to analyze lots of data in a single day for 5,000 companies. And what we're doing is we're going through cash flow statements, balance sheets, income statements, and hundreds of financial metrics. And we compare, as I said, a company to its sector, and we measure the strong from the weak, and we produce a directional recommendation as a result, which would be a strong buy, hold, sell, or strong sell. So that's a little bit about what we do. Not all quant methodologies are the same. We have that diverse approach where we focus on those 5 investment characteristics, and it's worked really well for us. So this just shows you sort of a recent history over the last 5 years of all our quant strong buys. On any given day, there could be about 350 to 400 quant strong buys, and we monitor it as a portfolio, and we compare it to Wall Street analyst strong buys as well as the S&P 500. And as you can see here, over the last 5 years, all our strong buys are up about 256%. And again, this is a portfolio that we maintain on a daily basis, whereas Wall Street analysts for the same period, it's up about 53%, and the S&P 500 outperforming Wall Street analysts up 84%, but certainly Seeking Alpha Quant crushing both of those. Now, this really is not an investable portfolio. You can't expect somebody to come along and buy 350 to 400 stocks, hence why we created Alpha Picks. So we're going to take a deeper dive into that a little bit later. We do often get a question, why quant? How did it start? And as I mentioned, computer processing is an essential part of it. And in the 1970s, with the rise of computers and quantum computing, we were able to take mathematical models and input financial data and start assessing basically every stock we want to assess that's investable. And as a result of that, we can also take historical numbers and perform something called a back test. So when we load up the history of stocks, being all those financial statements, as well as the metrics, we can identify patterns and we see which metrics are more predictive than others. Hence, we can focus on those and place greater weights on metrics that prove to be predictable in terms of having improved performance for stocks. And that is really how quant started, and very successfully. Today, it's one of the most powerful forms of investing. A lot of people use AI and quant together, and that's sort of really fundamental analysis on steroids when you combine both of them together. And largely, quant very much is closely aligned to AI. We're using big data. We're using historical patterns. And systems do have the ability to learn, or there are fixed methods. And we actually go with proven, diversified fixed methods as opposed to a dynamic method where the system continually learns. And we have just found actually that provides us with better performance. And our track record obviously shows that as well. So not only do we have that overall strong buys to look at, but we created a product that is investable, which is Alpha Picks. And as you can see, since its inception, a little over 3 years ago in July 2022, Alpha Picks is up 251% compared to the S&P, up 78%. And we make this very investable. It's only basically we provide 2 of our favorite stocks every month. So instead of you having to scour through the research of 400 strong buys on a daily basis, this in essence serves you our best ideas on a silver platter. Before I take a deeper dive into Alpha Picks and how it functions, I do want to go over the current market and the economic backdrop, which most people are fairly uncertain. And I think the CNN Fear and Greed Index shows that uncertainty through its neutrality mark right now. Many times we can look at the CNN Fear and Greed Index and it will be an extreme fear or extreme greed. Personally, I actually find this really useful when it hits extreme fear. To me, that's sort of a buy signal. In essence, when others are fearful, you should be buying. I can't say the same is true for the extreme greed that I necessarily want to be selling at that point, but I have found historically when it hits fear, that's a good time to be buying. So the CNN Fear and Greed Index stands, as I said, at neutral right now. It is sort of in a stalled space. The market's defied seasonal weakness. Typically, over the last 10 years, October has ended up in the red. This year, it's been a little bit different. But today, hey, we're seeing a rotation into some safe haven sectors. So the month is not over yet. The market landscape grows increasingly bifurcated. Risk on tech especially in AI, which continues to surge, and gold continues to surge as well. So it seems to be sort of at very strange polar opposites to have technology and gold surging at the same time. But that is the state that we find ourselves in right now. And with AI, it is a boom that you could see there's no slowdown. If you look at the hyperscalers CapEx chart on the right-hand side, you could see how CapEx is climbing in the future years from the investments made by Microsoft, Amazon, Alphabet, and Meta. And it is absolutely going through the roof. So there's no slowdown in AI. And perhaps that as an individual, you might find that you use AI yourself. I certainly know we do use AI here. And it's not just the mega cap companies that use AI. AI, in essence, is a way for companies to scale and become more efficient. And you're not going to find a company that does not want to do that. So, literally thousands and thousands of corporations are incorporating AI into their daily workflow. And you can see through these CapEx levels just for these mega cap stocks how powerful that's becoming. To get us started, next chart. Something else that fuels the market is not only growth in CapEx, but also potential interest rate cuts as well. And the market has been quite keen to get some interest rate cuts. Inflation was sticky for a while, and it still continues to be a little bit sticky. But what is disconcerting to the Fed at this point is weaker employment data. And nobody wants to see people without jobs. And as a result of the labor markets getting weaker, the Fed did make a cut back on September 17th. And as you can see from the Fed dot plot, there are two more rate cuts that are anticipated in 2025. So what are some of the factors that are contributing to that? And also gold going to an all-time high. As you can see, it is just hockey sticked since 2023, continuing to climb through 2024 and hitting all-time highs now. Well, we have weak labor data that has contributed to the monetary easing that's happened so far, but that does raise questions about the economy. So if there's uncertainty about the economy, a lot of people do like to seek out gold. There's also geopolitical risk that has been very apparent for the last several years. So as a safe haven investment, people have sought out gold. Early in the year, probably no one recalls it since the market has been going to all-time highs, but we had quite a large pullback that started in February and went through April, and that contributed to gold going higher as well. And we continue to see central banks across the world buying gold to diversify their reserves and reduce their reliance on the US dollar. So there are a number of factors that have contributed to gold going to record highs. And many of those factors, as you can see, are still there. So it is contributing to the demand side of the equation for gold. In terms of where we are in valuations, you'll probably hear this on CNBC or Bloomberg News or just reading the Wall Street Journal, with the market going to new highs. And typically this goes hand in hand with the market going to new highs. Valuation reach extreme levels as well. So we do have stretched valuations in tech and AI focused companies, which does heighten the risk of a sharp market correction. So equity market valuations, especially for the NASDAQ, are well above historical averages, driving to past comparisons with bubbles, similar to what we had in around 2000. However, I will say more companies are earning money now. Having been in the markets in 2000, there were a lot of stocks that were going through the roof that have absolutely no revenues and no earnings. So it is actually a lot different this time than it was back then. At that period, also, you had companies that had revenue with very little earnings that were able to actually provide financing to their vendors and suppliers to keep that bubble going. This time, you have companies with tremendous cash, which are the mega tech stocks and the largest companies in the S&P 500. They are flush with cash and they're making the investments. So it's not so much on leverage this time as it was back then. However, we do have tightening credit spreads and rising asset prices, which persist. So to many investors, that does signify the underpinnings of what could serve as a potential pullback or correction. So I will say, Emma and I performed a study earlier this year, and this was in response to the market correction that we had. So certainly the market's close to an all-time high now. You never know when that correction can occur. Usually there is some systemic catalyst out there that does cause markets to pull back, or just uncertainty in general. And what we found in assessing previous market corrections, and we took the last 5 market corrections going back to 2010, and the markets were down 15%. So whether they were down 15% and continued to go down 20, 30, 35%, if you used 15% as sort of that line in the sand, and you bought just the S&P 500 when the market was down 15%, on average, if you held it from that point going out 2 years, you were up close to 50%. And that's just buying the S&P 500. What we also found was if you use that 15% rule as the time to buy, and you purchased the top 10 quant stocks, if you held those after that buy point, they were up on average 117%. So the rule of thumb, and it doesn't always work for every correction, but on average, we found from the last 5 corrections, the last 5 pullbacks, if you had purchased the market when it was down 15% and you held it for 2 years, you did very well. So we often tell people when we hit those periods in the market to take advantage of it. If companies have good fundamentals, you can't be too concerned with the macro news or the talking heads or the guidance that's coming out from a strategist or economist. Just stay disciplined, find companies with good fundamentals, and keep buying month in and month out. And that creates generational wealth. Where are we on our slides here?
Let's see. I mean, we're jumping, I think, to introduce the AlphaPix portfolio, and I'm happy to dovetail what you were just talking about, stocks with strong.
Yeah, please do. Yeah.
Because I think this is a great illustration of that. And so every quarter we keep track of which AlphaPix have beaten earnings and revenue expectations, and we have a phenomenal hit rate. As of Q2, 89% of AlphaPix beat earnings in Q2, and that was compared to the S&P 500's 81%. So I've included the EPS revisions grade here, which is an indicator of what analysts are projecting earnings to be in the future. But if I were to include their other fundamental grades, I think you'd probably see lots of A's and B's as well. I think this list of stocks really showcases that AlphaPix, as a product that's derived from the quant system, are great at, or the system itself is great at picking the stocks with the strongest fundamentals. So like I said, 89% beat EPS estimates. That's compared to the S&P 500, where 81% of companies beat EPS estimates. I'll add that the AlphaPix portfolio tends to has a better entry price. It's AlphaPix operates with a growth at a reasonable price philosophy, and so you're getting that potential at a more attractive price. And this is the 10th consecutive quarter, I believe, or maybe 11th, where the portfolio.
I think you highlighted it was our 11th consecutive quarter where we had beat earnings above the beats for the S&P 500 overall.
Yeah. So this is just, like a high level takeaway of how the quant system does an excellent job of choosing the stocks with the best fundamentals, and AlphaPix is able to distill that down to 2 picks a month.
All right. So go ahead, Emma.
No, this is what I think what you just highlighted in terms of how to build generational wealth. It's impossible to time the market and you can't control the level of volatility, but what you can control is how consistently you put money into the market. And so dollar cost averaging is a strategy we always stress here at AlphaPix. Consistency on average creates excellence over time. So, 2025 in my tenure in the industry has been one of the more volatile years. February through April was extremely volatile, and AlphaPix definitely several stocks took a hit as a result. But if one were to maintain discipline and keep investing in the portfolio, they would have seen phenomenal returns in some of those stocks that were the hardest hit at that time through this period. So again, the importance of dollar cost averaging, no matter where we are in the market cycle, is just like an important adage to remember for any investor. All right. So Steve, did you just want to go over the high level stuff and then I'll jump in and jump in on strategy characteristics, etc.?
Sure. Yeah. So this is obviously showing alpha pick returns over various periods. We mentioned earlier, as you can see on the bottom, what the return is since its inception in July 2022. But if you look on the far left-hand side, you'll see over the last year, 52 weeks, alpha picks is up 42% versus the S&P up 17%. If you look at the center for the 3-month period, that shows alpha picks up almost 25% compared to the S&P up 8.5%. And if you look year to date, Alpha Pix is up 35% versus the S&P at 14.85%. So looking at various time periods going back to inception over the last year or just the last 3 months, Alpha Pix has consistently outperformed the S&P 500. So a little bit about what Alpha Pix is. As I mentioned earlier, we are providing our 2 top ideas every month. On the trading date closest to the first of the month and the 15th, we send out an email. We also put it on the AlphaPix platform as well. We're very transparent. We provide a detailed analysis on the stock that we're picking, the price that it's picked at, and then that goes onto the platform under the portfolio performance, and we will actually show the weight that it has in the portfolio. Typically, as new stocks come on, it's got about a 1% weight in the portfolio. We have close to 40 stocks in the portfolio right now. It is intended for long-term investors. When we provide this, there are some parameters and criteria for a stock to make alpha pick. So we're not strictly just going with our top quant strong buys. We're looking for companies that have a market cap over 500 billion. There has to be a certain amount of liquidity, and the stocks predominantly have to trade in the United States or be primary ADRs, of only which there are a few primary ADRs. We're not really looking at ADRs across the world. So it is very centric towards the United States. And market cap, as I said, has to be above 500 billion. How does it work? Well, the quant process relies on analyzing terabytes of data to employ best-in-class optimization and risk tools. And if you look to the right-hand side, you can see there's a rating summary card. And on that card, we actually show 3 independent sources that rate stocks for every company. So we take the consensus of Seeking Alpha contributors, we take the consensus of Wall Street, and then you have the quant strong buy. For the purposes of this illustration, really the only thing we're looking at is quant. We don't incorporate the Wall Street analysts or the contributors' recommendations into our opinions. But if you look below the quant strong buy, you'll see the factor grades. When you look at the factor grades, it's always sector relative. So you're looking at it for a company versus the rest of its sector. And those factor grades give you an instant characterization of how that company compares to the sector on those investment characteristics. So if you're looking at valuation, growth, or profitability, you know exactly where that company stands versus the competitors. And basically what we do is we have scores that are assigned to those investment characteristics, and we total it up for each company. And that's how we determine the highest and lowest rank, and we can assign a directional recommendation of strong buy or strong sell or hold to it. I mentioned the strategy characteristics. We're looking basically for 2 trades a month. Occasionally there's a sell, so there might be 3 trades a month. We aim to keep the turnover fairly low. And as I mentioned, the market cap has to be above 500 million. I did review earlier what the criteria was. The stocks do have to be a strong buy to make this portfolio for at least 75 days. It does not invest in REITs or ETFs. And it has to have a 3-month average market cap greater than 500 million. And we're also looking, the stocks have to be over $10. So we're trying to reduce the amount of volatility. And also, if a stock makes it into the list and comes out, it will have to wait another year before it can come back into the portfolio. Having said that, we can have a stock in there for a year, and after 1 year, we could put that position back in the portfolio again. But we're not going to be saying, January buy IBM, and then in February and March saying buy IBM as well. So it gets it once, and then maybe it can make it back in again in 52 weeks. When do we sell? When a stock falls to a sell or a strong sell. We do not sell a stock. I'll repeat, we do not sell when a company's rating drops to a hold. And in fact, we actually leave it in the portfolio for about 180 days. Once it hits 180 days as a hold, we will then take it out. But we find many stocks that we just want to let our winners run. And often those winners can have a hold recommendation on it. A little bit about the portfolio itself. So these are historical numbers just to give you some guidance on growth and value for AlphaPix versus the overall market. So you could see for the growth metrics, if you look at the revenue line, the AlphaPix portfolio on average had about 15% growth compared to the S&P 500, which was close to 6% growth. If you look at the second row, the earnings per share growth for the AlphaPix portfolio on average was 46% versus the S&P at only 13.8% growth. And then from a valuation perspective, the average PE for the AlphaPix portfolio was 22 times versus the S&P at 26 times. So as you can see, the portfolio is bringing you better value with much stronger growth. Emma, I'll let you tell us a little bit about dividends.
Yeah, definitely. The AlphaPix portfolio is really cool because you can slice it, dice it a number of ways. And one way we've recently looked at the portfolio, given the volatility we had earlier in the year, the recent Fed cut that took place, which tends to favor dividend stocks. We looked at some of the companies that do offer a dividend. Now, I'll say the objective of the portfolio is to choose two stocks that are best positioned for capital appreciation. However, we do have some income generating positions within the portfolio. We have 9 at the moment. That in the time I've been working with the portfolio, I think it's fluctuated between like 9 and 15. So there actually is a good number of stocks that pay dividends. And collectively average, they boast a forward average dividend yield of about 1.6%. And when you compare that to the S&P 500, quite a bit higher at about 1.1%. When you look at a really standard industry benchmark, the VIG, it's about the same. So in addition to that potential for long-term capital appreciation, you can also potentially capture some income along the way. And I'll highlight, we've included, in this roster, their dividend grades. I've actually seen a few questions come through that ask if we rate ETFs in a similar way, if the quant system rates ETFs in a similar way. And the answer is we do. We do have ETF quant grades, and we also have quant dividend grades. And they're really important for income-focused investors because it can give you an idea of, or a really holistic lens on your dividend. So it evaluates dividend safety, how likely you are to be able to maintain a current dividend, potential for growth, how its yield compares on a sector relative basis, and consistency, which are all important considerations for those who have an income focus. So if you look at their dividend safety and growth grades, which are grades we really like to stress here at on the quant team, they're really, really good. Mostly A's and B's in terms of safety, a few poorer grades in terms of growth, but they offer superior dividend grades relative to the sector in general, I would say. We've also highlighted these because, again, in these sort of uncertain environments, a barbell strategy is often a prudent approach, which blends both dividend stocks and growth stocks that help investors balance income with long-term capital appreciation objectives. And this can create resilience along market cycles. So, like I said, this is one kind of subsection of the portfolio we like to highlight. And if you do end up becoming a subscriber in our bi-weekly updates, which I'll touch on later, we like to highlight other aspects of the portfolio. So you'll see there's a lot of different thematic undercurrents in the portfolio that are really interesting to learn about and might suit one investment style better than another. So just wanted to highlight that. And then the winner's circle is an interesting component to the portfolio. We keep track of stocks that have doubled their share price since they've been added to the portfolio. And we've got an incredible number right now. Over 10 AlphaPix have returned more than 100% or 100% or more since their addition to the portfolio. When you think of that in the context of this portfolio tends to range in between, I'd say, 35 and 38 stocks at any given time. That's a really excellent number. Demonstrates that the portfolio is really good at picking winners. Of course, that's not all stocks. We do, of course, have companies that have underperformed, but by and large, the winners that have been selected tend to outperform the losers. And so we've got two of our biggest ones right at the top here. AppLovin, that was actually recently trimmed because it had returned so much, it had breached our 15% concentration limit. So we actually had to recently sell off a bit of AppLovin. And then Celestica is another stock that was originally added in October of 2023. Steve, did you want to jump into the platform to highlight the
Yeah.
stocks? Okay.
Yeah, so I want to show you a little bit about those stocks, and we're going to switch over to our platform. And just as like Emma pointed out, some of those positions we actually do cut back when we find the weight is over 15%. So this is actually taking you to the AlphaPix platform live on a real-time basis. So there's a dedicated site for AlphaPix. And I'll just show you, there are a couple other tabs. There's an About tab, which if you forget everything we say today, you could just go to this About tab. There's a short video that will tell you about it. And then you can go through some of the text and narratives, which will tell you how to get started for AlphaPix, what the buy criteria is, what the sell criteria. So you don't have to take notes. It's all there for you. The analysis, as I mentioned, we're very transparent. Every company that we've recommended, the article is here since July of 2022. So you can go back and see historical articles as well. And then, yeah, when you're looking at the performance, it shows you the actual date that it came into the portfolio, what the price was. And if you go to the portfolio page, it actually shows you what the weight is. You can see with AppLovin, there's a close, a pick date and a close date. That's the percent, that portion that we took out of the portfolio. We reallocated it to all the other stocks in the portfolio. And that was at a return of 1,571%. But then when you scroll down, you can see the position that's still open. Looks like we took our profits at a good time because it's come off a little bit since that time period. Another stock that was similar, which was Super Microcomputer, ticker symbol SMCI. We put it into the portfolio in November of 2022. We took it out on March 2024. That had a return of 968%. A current open position is Celestica, which is up 851%. And Sterling as well. So what I'm going to do is I'm actually going to take you into those two stocks, and you'll see that despite those run-ups, so we have switched to Seeking Alpha's premium platform. So we're out of AlphaPix. We're into Seeking Alpha Premium. Many of you may be familiar with Premium. You can see there's a chart here, and on this chart, you can see the price performance over a 1 year period, year-to-date period. The stock is up 181%. Over the last 6 months, it's up 277%. And I think, what is really nice about this is even though the stock is up 366% in the last year, 52 weeks, if you look at the factor grades, you could see how it has changed from what it is right now to where it was 3 months ago and where it was 6 months ago. From a valuation standpoint, the stock has gotten more expensive. So that grade has dropped from a B to a D, but a D is still good enough for it to make a strong buy. From a growth perspective, the company's growth is still just as strong now as it was 6 months ago. Profitability is still at a B minus, just as strong as where it was 6 months ago. The momentum of the stock compared to the sector is actually stronger than where it was 6 months ago. And in terms of analyst revisions, they continue to revise their estimates up for this company, so it's very strong. But the beauty of these factor grades is you are one click away from taking a deep dive. So I'm on growth. I'm going to click on growth, and that is going to show you just a whole ton of growth metrics. Looking at revenue year over year, or forward revenue, or EBITDA growth, or EBIT, or EPS, levered free cash flow growth, operating cash flow growth, ROE growth. We have a ton of growth metrics. And the beauty of these metrics, if we go to the one on top, revenue growth year over year, that A minus gives you an instant characterization of the company's revenue growth versus the sector. But we provide the absolute number too. We're very transparent. So the absolute growth rate year over year was 20%. versus the sector at 6.9%. So that's at a premium of 196% to the sector, hence the A minus grade that you see there. If you were to look at EPS year over year growth was at 77% versus the sector at 9.3%, hence that A minus rating. So again, you can use those academic letter grades just to give you an instant characterization of where it stands. Sterling is another stock in the portfolio. I'm going to click on that now. Over the last year, that's up 130%. As you can see, the valuation grade has gotten a little bit more expensive, but D still puts it in the camp where it could be a strong buy. But if you look below, you see the growth. The growth is actually stronger now for Sterling than it was 6 months ago. So the growth rate is a B versus 6 months ago was a C plus. And again, that's versus the sector. So strong growth compared to the sector. Very profitable very sector. Great momentum against the sector. And analyst revisions much higher than the sector, as you can see by these A grades. So that gives you a little bit of a deeper dive into it. If I were to click on the valuation, where you'll see some red because it has gotten pretty expensive, you will see one that pops out in green, and that's my favorite ratio. It's the PEG ratio, where it actually combines the PE and the growth of the company into one metric. And the reason why I like it, when you look at the value metrics for a company, it doesn't really tell you anything about growth. So if I look at the top line and I see PE, yeah, I know for price over earnings, it is expensive versus the sector at 48 times versus 21 times, but it really doesn't tell me enough until I bring that growth component into it. And once I add the growth component in, it actually is cheap versus the sector. It's at a 57% discount to the sector on a PEG basis. But we don't put all our eggs in one basket. We put various weights behind each of these metrics. Some are stronger than others in terms of their predictiveness as an indicator. So those weights do vary, but PEG does carry a fairly strong weight. And then we take the overall score, and you can see it provides a D grade. So I wanted to show you something that was red as well as green. And then if we look at profitability, looking at a bunch of profitability metrics such as gross profit margin, net income margin, return on equity. One of my favorites is actually, two of my favorites are return on equity, where it has an A grade, and it's 36% return on equity compared to the sector at 12%. And then one of my other favorites is cash per share. This company has almost $23 in cash per share versus the sector at $2.30. So this company is literally a printing press in terms of its cash per share, and that is Sterling Infrastructure. Emma, I'm going to take us back to the webinar and the deck, and I'm going to let you take over there. And I think we'll move on from the next to the next slide.
Great. Actually, this is really appropriate. I've seen a number of questions come through. How can new users get going with AlphaPix? I think it's an important time to stress we're not a fiduciary, and so we cannot make personalized recommendations on how exactly you should invest your money. However, we can provide, some broad general guidance, and that is for new subscribers, you could buy at least 5 strong buy rated AlphaPix from our existing portfolio to invest your capital. For those seeking a more diversified exposure, buying the entire portfolio using the allocations in the portfolio tab is another strategy. And then I think for another kind of type of investor who maybe has a strong conviction in their own investment process, we have many folks who use AlphaPix as an idea generation tool. So they wait for the picks, they read the analysis of the picks, and they see if that is best suited for their investment style. While I'm here, it's probably a good reminder when the analyses do come out, I can't recommend enough to check out the comments, because we have a really robust commenting community, some really sophisticated investors with great ideas, and there's a lot of just healthy exchange between folks who have an opinion on the stock or how it might fit into a broader portfolio. So while we ourselves, obviously we're not fiduciaries, we're not going to provide professionalized guidance. If you're just looking to augment your education, become, a little more knowledgeable yourself, in addition to taking in this type of content, check out the comments, because there's a lot going on there. Okay, so this is just some housekeeping, and if you're new, if you choose to sign up, there's a whole process kind of behind how we distribute the picks. So alpha picks are released closest on the trading day closest to the 1st and the 15th of every month. And those are posted on the analysis portion of the platform promptly at noon Eastern time. And that'll be your first peek at the pick for that month, or for they're released twice a month. But and then shortly thereafter we release an email. There is a slight manual delay. So if you want to be like a first mover on these, I really recommend being on the analysis page of the platform right at noon on the day of the release. For performance purposes, we use the volume weighted average price. This is a standard industry benchmark that's calculated over a single day that considers both the price and the trading volume. I will say, and this is probably a question that'll come at the end, some of our selections are small cap stocks with lower floats. So when the announcement is initially made, we can see modest price spikes. We always advocate, you don't necessarily need to buy in at that time. Those price jumps usually correct by the end of the day, but we do want to be transparent about how performance is calculated, etc. I touched on the email already. And then the webinar, we have webinars the same day as the release. They take place at 4 p.m. Eastern time, within hours after the pick being released. In those, we'll go over some portfolio level performance. We talk about the stock in depth. We look at, some of the narrative drivers of performance. Then we'll do a deep dive on the quantitative drivers for performance and, justify its selection as a pick. So those, again, are great opportunity to reach out to Steve or myself to ask questions, get clarity on some stuff. We really like to take those as an opportunity to just be interactive with subscribers. So, if you do end up becoming a member, highly recommend attending those. And then this is cut off a little bit at the bottom, but what is the best way to ask questions for the webinar? As I mentioned, always leave comments. We monitor those very closely prior to the webinars. And the live chat, which you guys are doing a great job of doing. I monitor the chats and try to integrate questions as we see fit throughout the presentation. So that's just some general housekeeping of how this works if you choose to subscribe. Oh, and then I touched on this. This is a bit of a new addition. We had been doing a Alpha Picks market recap, which touched on some, really important critical news within, driving market movement. So, sector analysis, geopolitical events, et cetera, things that might be moving markets. We've revamped it a little bit. This is now released on a bi-weekly basis. And in that, we do provide a in-depth, what we call a portfolio review. So we're really looking under the hood of performance and calling out, any news-driven events that might have moved stocks within the portfolio for that week or that previous 2 weeks. Like I said, we look at some of the subsections within the portfolio. So, we've got a number of material stocks in there that are doing some pretty interesting things. But just look at major drivers of performance, major detractors, et cetera, and try to contextualize those with what's happening in the broader market. So that is one benefit of becoming an AP subscriber. Okay, Steve, are you ready for some questions?
I am ready. Yeah, let's hear them.
Okay. These range, they're all over the place. So we'll move through them. But okay,
you did a good job writing these down during the presentation. You're a good multitasker.
Yeah, see me typing. Okay, so what time of day are the quant ratings updated?
They usually start about 4 a.m. in the morning, and it's typically about a 2-hour process. And that ranks close to 5,000 stocks every day. As I mentioned, we go through income statements, cash flow, balance sheets, and hundreds of financial metrics for each stock, comparing it to other stocks in the sector. And believe it or not, we're able to do that in about a 2-hour period. And it's because we have a great algorithm that's been created here and tremendous computer processing. So we can do all that in about 2 hours.
Okay, great. And that's before market open.
Before the market opens, yeah, 4 a.m. typically every day. Process takes about 2 hours.
Okay. This is a bit of an interesting question. But I think it helps illustrate or will help folks understand how the quant system works. How can we know actually if a strong buy today will become a hold tomorrow?
Well, we have to wait to see the data for the next day. And that, as I mentioned, we calculate that between 4 a.m. and 6 a.m. And then the system gets updated on the front end. So you would see, by example, if a stock were a strong buy and say the valuation grade changed from a D to a D minus, that is a trigger for our systematic system, and it would default to a hold rating. So that's just like one example of many, many, many points in our data system that can act as a trigger or a circuit breaker, hence moving a stock and downgrading from a strong buy to a hold or to a sell based on the move it makes and that the metric that's moving. So you wouldn't be able to look at it today and necessarily predict that, but once the data is basically scrubbed through our system and we run it and the new data is produced, it's at that point that we know. So you as a user would just go to the platform, and if you use our portfolio tool, you can set alerts and it will alert you to changes in metrics or changes in ratings. And that's how you would actually know, by setting those alerts, or if you're just looking at your portfolio on a frequent basis. There would not be an intraday change. It would only occur during basically an overnight, and the following day you would see that change.
Okay, great. That's a great explanation. This is this is asking you to be an oracle, and you're not going to answer it in the way, but I thought it was a good segue into talking about how alpha picks are mispriced securities, and that's why they're chosen. So, okay, the question or comment I should say is, shouldn't we just accumulate cash and wait for markets to correct themselves? Otherwise, we'll be left holding the bag for stock that may or may not recover. Maybe a good time to talk about like what happened earlier in the year with some of the volatility and our better performing alpha picks and the dollar cost averaging bit.
Yeah, well, I mean, looking at the question, the risk is you don't know how much the market's going to come down. Is it going to come down 5%, 15%, 20, 25? If you're, saying, okay, I'm just going to wait till I think the market hits a bottom, you really never know when that's going to occur because markets rotate almost on a dime. They're very sharp and quick recoveries often. And even in periods where that doesn't happen quickly, you don't know at what point the market will be coming back and what is that level going to be. So we found through our analysis that when markets typically have a 15% pullback, that's a good entry point, but it doesn't happen every time. That was like on average out of 5 corrections. So the best strategy is to find companies that have good fundamentals and actually just ignore market corrections and ignore market bubbles and continually look for companies with good fundamentals and invest, either on a monthly basis or a weekly basis by buying those stocks. And that's how you accumulate wealth.
Awesome. Thank you for that. I guess I answered this at the top, but do you run the same quant type of analysis for ETFs as well as stocks? Just curious. Maybe you could speak to our ETF grades a little bit.
Yeah, so let me go to the platform. So we're going to go back to Seeking Alpha Premium, and we're going to put in a very common ticker symbol, SPY, which is for the S&P 500. And as you can see, there are ETF grades right there. So the quant has a buy on this particular ETF right now. And just the way we do with stocks, for the ETFs, we compare it to all other ETFs, and we look at a momentum grade, we look at the expense ratio, we look at dividends, we look at risk, and we look at liquidity. And I'll click on risk to give you an example of what it is. And again, this is versus other ETFs. And you can see the S&P 500 has almost straight A's, but it's actually buy. There are others that rank higher. And the rank on this, even with a buy, it ranks 329 out of 3,158 ETFs. So first I'm going to click on risk. So you can see what those risk grades look like. We have standard deviation in there. We have percent of assets in the top 10 holdings. That's actually kind of high. Like their top 10 stocks for the S&P 500, it's a 38% weight. So that's pretty incredible that 10 stocks out of all the others. So there are 490, other stocks, and just 10 of them has almost a 39% weight. We look at annualized volatility, we look at turnover, and we look at tracking error in our risk grade. If you want to find out what the top ETFs are, all you have to do is go to rank overall and click on that. And that will show you the ranking of all of them and the quant grades. And there are many other categories that you can include. You just go into edit our portfolio and you can bring in a whole bunch of other metrics as well. But this is just sort of the starting point. And you can see the Schwab Crypto Thematic ETF is the highest one in terms of the quant score. I'm seeing blockchain is there as well. Bitcoin. So a lot of basically cryptocurrency ETFs ranking at the top right now. That momentum really, really carrying it. But you also have the ability to go in a screener if you don't want to look at crypto ETFs. You go to the ETF screener and you can look at top rated ETFs, allocation ETFs, international ETFs, commodity ETFs, alternative ETFs, taxable bond ETFs, sector ETFs, and US equity ETFs. So there are categories that we break it all down, and you can use the screener to identify those. So hopefully that answers your question on ETFs.
Yeah, and great little preview of the quant screener. I'm seeing a lot of questions in the chat about, distinctions between premium, alpha picks, and pro, and I included that in one of your questions, Steve. It would take too long, I think, to go through all the distinctions. But something to know about premium is that it's just like a phenomenal research tool that includes those quant screeners that you can move through. I dropped the bundled Alpha Picks premium price. So, if you want to be able to conduct your own research alongside, the distilled quant recommendations, which are the Alpha Picks service, that's a great price to take advantage of. So that is in the link there. And we will make sure to put that in the transcript replay of this recording, which will be available on the Seeking Alpha Video Hub within the next couple of days. I think we're close to finishing up on these questions. Maybe, Steve, we could just talk about, because this does come up from time to time, sometimes an alpha pick its price will spike following its announcement. How should we think about that? Maybe we could talk about small caps and
Yeah. So that would definitely be related to companies that we're recommending, as Emma said, with a smaller market cap. So we invest in companies that have a market cap of 500 million that would be considered small cap. Pretty much a small cap range is 500 million to 2 billion. However, with a company that's has a market cap over 2 billion, you're not going to see as much as a spike. But sometimes when we recommend a company that has a market cap at that 500 or 600 or 700 million dollar level, we have thousands and thousands of subscribers for Alpha Picks, and they're all buying at the same time. So in smaller companies like that, often we could see a price spike of like 5, 10, or even 15%. And my guidance is, if you see a company that is small cap, and when we write the articles, we will identify that. You'll see what the market cap is. I would say ease into the stock, maybe use a limit order. So instead of just putting a market order, put a limit order in. If it goes past the limit, you can see how the stock trades later in the day. You can actually wait a day or 2 or 3 or 4 before you go into that. Often there'll be a reversion to the mean. The dust will settle a little bit after that initial recommendation. Again, this really only happens on the market cap, on small cap stocks with a market cap that's usually like 5 to 700 million. It's not as much of an issue for companies that are larger. So that is the best way to work with these companies. And again, there's dollar cost averaging. So over a period of time, you get into these stocks as well.
Awesome, Steve. I think that covers a range of questions for today. What I saw come up the most, folks, as I mentioned, this will be available on the Seeking Alpha Video Hub. So please post further questions there, and we can try to address them. But Steve, do you want to close it out?
Yeah, so I would say I think we showed you a bit about Alpha Picks, where that's our service that brings you our top quant ideas. And then we also displayed Seeking Alpha Premium, which just gives you research on almost every imaginable stock. You have to do a lot more work yourself on that platform. I found both to be fantastic tools, because once I own a stock, I do want to see it in the portfolio tool. On occasion, I do want to be able to look at other stocks as well, and we have terrific tools on the platform to do that. So both of them in combination, I think really provides you with all the investment research tools you need. But if you just want us to do the work for you, AlphaPix is a great product. We give you our 2 top ideas every month. It's got a great track record. And I think that's it. I want to thank you for your time today and potentially being subscribers to AlphaPix or Premium. And on behalf of Seeking Alpha, we just want to wish you a great day. Thank you.
Thanks all. Have a great rest of your day. Take care.